So now we'll come to the final topic. I hope everybody had a good enough break. So this is, we are targeting it to be an hour long. And post that we'll open it to questions. I can say upfront, this topic triggers a lot of questions in terms of what is right, wrong, what can be done, can't be done. So I would advise that if we can put the Q&A towards the end of the session, otherwise we won't be able to complete it. So and depending on how long the CFA guys allow us, we'll have the Q&A session once we complete the sessions. Okay, so again,
how much time you think?
about an hour. About an hour.
So yeah, then after an hour we will have time for Q&A.
So we'll dig deeper into that and we'll interject just to make sure that we complete it. Otherwise, there is no point starting it and not completing it. So again, a standard disclaimer. This is only for educational purpose. We are only sharing our experience. Now, options is somewhat a more difficult concept to understand than just pure investing. And so at a basic level, I just wanted to get into just the broad semantics. I'm not trying to explain what an option structure is. Those who understand would understand pretty clearly, but those who don't have experience around options, they'll need to study a bit before they can understand what we are talking about. So options are financial derivative products whose entire value is driven by whatever is happening with the underlying security and the price action on the security of that, and accordingly the prices of the options get impacted. So for those who are new, conceptually it's easier to understand that options are like insurance products. So say you have a car, and an insurance company sells you the insurance on your company. And why do you buy a insurance on your company? So that in case an accident happens, you don't have to pay the large amount. So metaphorically, options are just like insurance. The option seller acts like as an insurance company. It's selling you the insurance, and for selling you the insurance, it's getting a premium as the insurance buyer pays the insurance company a premium, and the insurance buyer is equivalent to an option buyer, and the insurance seller, which is the insurance company, is equivalent to an option seller. So metaphorically, if you think like that, it might be a bit easier for people to understand. A standard option contract has certain underlying attributes. There is a call option which comes into play on the upside in case the security price is increasing. There is a put option that comes into play on the downside. There is the underlying. So the derivative contract always has an underlying. So what is the underlying security? Like an option product could be on the index, the Nifty or the Bank Nifty. It could be on an underlying security. It could be Reliance, Infosys, TCS. So in India currently, the option products, I am only talking about the equity part. The option products could also be for commodities. It could also be for currencies. So I'm not delving into that particular area. Currently, I'm only talking about equity options. So currently in India, there are about 195 scripts on which there are option products. So the inclusion of those securities in the FNO, which FNO is a future and option segment, and future is also a derivative product, but this discussion is largely around the options. So options always have a validity. They are valid to a certain date, and that is called their expiry date. So it is always, as part of the option contract, it is always there that at what date will they expire. Then options, because all the calculations are linked to what is happening in the underlying security price. So there is a strike price which determines how the value of the option will be calculated. And then finally is the actual price at which the option is trading. That is called the premium. So that is the premium aspect. So a brief history around options. So in an informal structure, options have been traded since prehistoric times, but we are talking about the modern history of options. In the OTC market, which when you say the OTC market, then you don't have a central exchange per se. So it's a contract between two parties. So early 20th century also there were in the OTC market there were option contracts, but formally on an exchange, options started trading in CBOE. So Chicago Board of Options Exchange, CBOE, they introduced options in commodities in 1972. Then options in currencies and bonds, they started in the 70s, and finally on the stocks they started in 1982. Coming to Indian context, so options got introduced in June 2001. They started with the index options, and July 2001 they started with the individual securities, the equity options. So this is a brief history about, so practically to speak of from 2002 onwards is where option trading started in real context.
Started then after first banning it earlier?
No, that badla I would not call it a badla is what happened between brokers. That is not really an option contract. That is more a future leverage contract. So they are not really options.
But at the time of badla it was mandi teji also.
No, but those are futures, not options.
Mandi teji was options.
Okay, then I am not aware about that particular.
We did that.
Okay, so options is again they became popular because of a model that kind of formulated what the price of an option should be. This is called the Black-Scholes model. It's called based on the people who derived that. They won a Nobel Prize for this also, and they devised certain variables based on which that equation got sorted out. So primarily there are 5 variables that these guys calculate. So delta, gamma, vega and theta. There is also rho, which is on the interest rates, but these are primarily, so I won't individually get into the details, but the Greeks drive how options behave. Next one. So for option traders, one of the big aspects is the payoff charts. So these charts are what highlight how the option price or the option value will behave as the underlying security price increases or decreases. So these are 4 scenarios. One is a call option buyer, the other is a call option seller, then is a put option buyer, and then a put option seller. So just to give an idea. And so at a 16,000 Nifty call, what does that mean? I have not talked about the expiry, but let's assume it's the November contract. So Nifty call means that at a 16,000 strike price of Nifty, if somebody has bought that call, so as long as the price is below 16,000, this contract would not have value till expiry. This line is what reflects the value. So at 16,000 value, it has 0 value. If it goes above this, then this option will have a positive value. If it goes below that, so all during that period, the value will be largely negative because of the premium you have paid in order to buy this option. So this negative aspect, this is the premium you have paid to buy this option. So the dotted line is what will reflect the values which are on a previous date, then expiry date, what it will behave like the price. But on the expiry date, it's the straight line that you can focus on. So so a buyer of a call will benefit in case the price goes up. Similarly, the buyer of a put will benefit in case the price goes down. So if you see that as the price goes down, it starts becoming positive value. And for the seller, it's exactly the opposite. So if the price remains below 16,000, he will make money because he gets the premium on selling the put. But if it starts going above 16,000, then he starts losing money. and this is for the call, and similarly for the put side. So this is the broad structure that I just wanted to give a gist of.
Can you explain dotted line again? What's the dotted line about?
So the dotted line is how the value of the option will behave on a date before expiry. Not the day before, but any given day. It's broadly, it will keep on changing, this dotted line, but this generally highlights how the behavior will be. So option, if anybody is trading option, one can choose to be an option buyer, one can choose to be an option seller. So the merits of buying and selling, what we are highlighting. So buying, one way to look at buying is that you're buying a lottery ticket. So, so you have limited downside, which is the price you pay for buying the option. So you bought the lottery ticket, it only costs you $5, $10 or whatever. But the potential in a lottery is that you can win a 1 lakh prize or 1 crore prize. But the probability of winning is very low. So similarly for an option buyer, he pays a fixed premium in order to buy an option, and his potential upside could be infinite. Theoretically it could be infinite, but practically what happens is those kind of such large price moves don't happen. Even if they do happen, the probability is extremely low. So it's you have the chance of winning large rewards with low probability, which is nothing which is very similar to what is equivalent to buying a lottery ticket. So, and what happens in the case of an option is option has time value to it, which is the premium that will keep on reducing as the time to it approaches its expiry date. So what happens is, as time passes, that decay in premium works against the option buyer, it works in favor of the option seller. So whatever is a benefit for option buyer is a negative for the option seller, and vice versa. So theoretically, the general perception is that option sellers, because they take larger risks and they're playing for the theta decay or the premium decay, they are more informed, and the profitable traders are considered to be option sellers. The unprofitable traders are the ones who are trying to buy the lottery tickets, and the sheer fact is that buying a lottery ticket, your probability of making profits is low. So if you're an option buyer and you want to be successful as a trader, then the skills required are extremely high. I do know of people who are option buyers and who make money, but they are few and far between, and their skills are at another level altogether. So selling is about you basically, as an insurance company, as I was highlighted, you're basically selling the insurance. So your unlimited downside is there in case an accident happens, and the upside is limited to the premium that you have got. So how does the insurance company hedge its bets? It basically insures a large number of individuals or cars. So with the probability, say they're insuring 1 lakh cars. So the entire idea is that accidents won't happen to the entire 1 lakh cars. Maybe 1,000 accidents happens. So it's a certain probability of a certain number of people happening, and they are willing to pay that downside. So again, if you talk in terms of the business model also, so an option seller behaves like an insurance company, and how will an insurance company survive? So insurance company says that I sell it to 1 lakh people, I get so much of money from these 1 lakh people, this is my pool, and after I make all the payouts on the accidents that happened during the year, if I still have money left, then I'm profitable. You still take the expenses out, which are the employee costs, their establishment costs, and similarly for a trader, it's the brokerage costs and all the transaction costs. If they take the money out, if still a pool is left, then they say we are profitable. So metaphorically, it's easy for you to compare yourself to an insurance company. So it's a lot easier to understand. So specifically in terms of our approach, we are sellers of shorter dated options and we are buyers of longer dated options. That's largely the philosophy we work on. So all the things we talk about are built on the construct that the price of an option will follow a normal distributed curve. So that is the starting premise about options, and all so Black-Scholes model also works under the same premise, and so that's why we just highlighted the graph. In terms of styles of trading in options, some people trade options based on technical indicators. There's this entire field of study where people are using charts and patterns in order to say that the patterns will determine what the future price action will be, and basis that you can trade options. So that is technical analysis. So a lot of people there. Then there is the quantitative field where people are calculating probabilities in real time based on the normal curve distribution and trying to see that whether the risk reward is in their favor or not. And then there is the other stream where rather than calculating these probabilities in real time, the people are playing for a mean reversion, which means that if anything is deviating from the established norms or the mean, then they will tend to return back to the mean. So it's the opposite of trend. So if the deviation has happened, you are playing for the probability that it will revert to where the mean is. And then trading horizon, there are two. A lot of trading happens on an intraday basis. In the morning, people take positions, and before the market ends, they close their positions, whether at a profit or loss. And the other is positional, where you carry your positions to the next day, to the next week. So that depends on the duration of the option contracts. So some of the strategies are so two broad strategies. One is mean reversion, where people are saying that it will revert to the mean. There's the other strategy which is directional. They are strategies within that: straddles, triangles, ironflies, condors, butterflies. These are technical terms. I won't delve too much into them, but all these are strategies that people deploy. So just highlighting them. The big thing that is happening in the Indian market is that the option volumes have exploded over the last 5 years. So to give you a context, just in a year, the option volumes have gone up 1.5 times, and currently, if you say NSE, which is the largest listed exchange, currently almost 80% of their revenues are coming out of options trading. The equity portion is now 20%, and the share continues to decline for equity. So now NSE sales and profits are both determined by what is happening in their options, and that's why more and more products are being launched in this space. So there is a sub-segment of an option strategy called covered calls. Our experience is more around covered calls, so we are going to delve a bit more into this particular strategy, and we'll share the basic constructs of what exactly we do. So it's a income generation strategy. As I highlighted, we are trading options to generate income on a monthly, on a quarterly, or a yearly basis. So it's an income generation strategy, and we are selling options again here. So when you sell options, you collect a premium, and we consider that premium as the income we are trying to generate. And so in terms of the strategy, it's an income generating strategy that collects premium while selling options, but also tries to mitigate the risk of selling that premium. So what exactly is a covered call? So covered call is you basically buy the underlying. So whatever the option underlying, you buy that either in cash or in future, and then on top of that you sell a call on top of that, and the strike price of the call is something that can be determined by you. We have a certain philosophy of what strike we want to sell at. We'll share a bit about that. So covered call it talks about owning the stock or the future of that stock and selling a call option on top of that. So, and what is the philosophy why we want to do this is that we are comfortable with holding the underlying future of that stock for whatever reason. In our case, it's a more a fundamental view about that particular company. And so what they say is ki those who intend to hold the underlying stock for a long time, we want to hold the stock for a long time because we are comfortable with the valuation. But do not expect a big move in the short term on the upside. So what does that mean? That means that we are comfortable holding. That means that the stock won't correct materially in the short term. But at the same time, we are selling the options far away so that those options, whatever premium we have got on the options, we get to keep it after the expiry of the contract. So so there is this concept of balanced and unbalanced that we have introduced, and why we have introduced is because a lot of if you go on the internet or read academic literature, there's a lot of terminology around covered calls, but the covered calls that they talk about are one version of how it can be done. So what is we call the balanced covered call. So whatever quantity of underlying the cash, the stock or the future that you have, you only sell that much amount of calls on top. So that is the balanced when 1:1 ratio is there. But there are also other strategies where you tend to sell less. So if it's less than 1, then again it becomes unbalanced. If you sell more than 1, then also it becomes unbalanced. So in case it's a 1:1 ratio, what you are doing is that you are earning that premium, but after that you are capping your upsides. When you are selling less, if the price goes up, you still make money, and if the price continues to rise, you still make money, but lesser than what you could have potentially made. But if you sell more than 1x, what happens is, if the price starts keep going up to a certain point, you make a lot of money. But after that, if the price continues to go up, you start losing money. And that is largely because you have sold more calls than you have the futures, so you are net short in the market. And if the price keeps going up, and since you are short, you start losing money. So again, a simple methodology. I'll just stop for. So there's this concept of in the money, at the money, and out of money. So at the money means that when the market price of the underlying is equal to the strike price of the option. Out of money means when the market price is, and we are talking about call options, so market price is below the strike price of the call option, and in the money is when the market price is above the strike price of the call option. So typically, how does a portfolio behave of a covered call? And so in a bull market, when the prices are continuing to rise, in a covered call portfolio, you will make returns, but you will tend to underperform the market because your upsides are capped because of your sold calls. In a flat market, you will outperform the market because while the market is going sideways, you are continuing to earn the premiums sold on the top. In a bear market, you will again outperform the market because again you continue to earn the premiums that you have sold on the top. So next one. So this is a study that happened. So there is a index that has been made by CBOE in 2002, the buy right index, which is nothing but basically this is for the S&P 500. Basically the idea is you buy the future on the S&P 500 and you sell 80 at the money call on top at the start of every series and continue the position right till the end, till the expiry, and see how the returns are done. So basis that what the findings are. So while the index returns on an annualized basis, this is 1986 to 2012, so it's a 26-year period. So the returns between the two are almost identical. It's still better than the other asset classes or the other benchmarks they have, but the returns are broadly identical. So then what's the advantage of selling the covered call? So what they have tried to highlight is there's a similar return. The returns are better than some of the other benchmarks, but the standard deviations are lower, the drawdowns are lower. So on a risk adjusted basis, you can say that the returns are better. But if you include the transaction cost and the tax implications of trading, then on a net level, the returns would be worse than the index. Then what's the point of doing the covered call? So this is just a quote of a trader who's done quite well trading options. Next one. So here is so we started calling our way of doing things as unbalanced covered calls, where we tend to sell more options on top, more call options on top than compared to the underlying. So and then call can be, the covered call position can be started in two ways. You could buy the future and sell an out of money call on top, or you can simply sell the put to start with, and only once the put comes into the money, in the next series you convert it into to a covered call, only if the put price gets breached. So there are two ways to do it. We initially started by selling a put because we thought it's a safer way to do it, but over a period of time we have converted to simply starting with buying a future and selling a call on top. So since we are selling more calls than futures, we are net short on the market. So in case the price is going up, we just can't do that transaction and just go to sleep. So we need to actively monitor and manage our positions in case certain things happen. So, so ways to manage an unbalanced covered call is, in case the stock price is moving slowly, what we will do is the calls that we have sold, we'll buy those at a slight loss and sell calls at a higher strike price. So that is one way of managing. So this is, as a concept, it's called rolling up. So, or alternately, if the move happens sharply, then the other way is to basically sell put on the same strike or a lower strike. There are infinite ways to manage things. What we are trying to highlight is what we do. So I will not get into it that this is the best way or this is the most exhaustive way, but just trying to highlight what we do. So why covered calls? The underlying share that we have a long view on the stock. We feel that either the stock is cheap or reasonably priced. So, and our big aim is to make earn the premium that we are selling by the call that we are selling on top. And in the long term, our alpha is going to be driven by out of those premiums that we are selling on top. This strategy works very well when the option premiums are high, and that happens when the markets are a bit volatile. So because ultimately our option income is driven by the premiums we are getting. Higher the premiums, higher is the chance that we will make more money in that. So and why we do this is we initially started with the premise that we can make better or similar returns as investing, but definitely with lower drawdowns. So drawdown is a theme that played in my mind a lot. So the idea was, the bigger idea was to reduce the drawdowns when we started this trade. And especially, and in case there are special situations where there is an open offer on the underlying, like ACC Ambuja, then these strategies can really give enhanced returns because of the special situation, big moves can't happen, and it's very easy for you to generate money without taking too much risk. Next one. So in terms of the margin creation, the construct we have is whatever pool of money is, say 1 crore is the pool of money, we'll buy liquid funds out of that 90 lakhs, we'll buy liquid funds, pledge those liquid funds and give that pledge, use the margin that is generated out of that pledge to start trading the options. So 10% we keep aside because we need to fund the M2Ms that keep on happening on the future contracts. So we need some level of liquidity in order to fund the M2Ms. Portfolio construction, while there are option contracts on 95 stocks, in our case we want liquidity to be at a certain level, so we consider the top 100 traded stocks in terms of the volumes, and that is the universe out of which we want to select our stocks. So we
One clarification. So this is completely separate from your long only portfolio.
yeah, this is absolutely different from the long only portfolio.
You don't do any covered calls in your underlying portfolio.
No. So my underlying portfolio will only have small stocks. They won't be in the FNO space.
Does that give you comfort that ultimately you are short, but there is a one pocket in which you have a long-term asset?
Yeah. So to some extent that is a comfort. So his question is more around the fact that I'm selling more calls than I have futures in this covered call portfolio, and I sell more calls than why I'm taking that extra risk. So part of the reason is because I have a portfolio that is of a bigger size on which no calls are sold on top. So in case the market rises, that portfolio will gain. So that is, in a way, it hedges the risk that I am taking by selling those extra calls. That may not hold true for anybody who is just doing it on its own, and for them the risk will be higher than what I take.
The previous slide you mentioned lower drawdown. Can you please elaborate on that? Because in fact you are buying futures and selling calls. So when the market goes down, how are you managing?
So I'll say my portfolio value is 100. Okay? The index value is also 100. Now the index corrects, and then on a 110 strike I sell a call, say, for 1 rupee. So net now I have 100 at the underlying value plus 1 rupee. Now say the market corrects by 20% and my portfolio also corrects by 20%, 1:1 correlation, let's assume. So now what I am left with is while the index is at 80, I am at 81. So and then I'll keep I'm giving a simplified example. As the market goes down, I'll keep on selling more calls. So by the end of the month, I may have sold 2 rupees worth of calls. So as the year passes, I'll keep on adding this, all the premium that I'm getting by selling the calls on top, that keeps on reducing my drawdowns. No? So you get the context.
But in a runaway market, that reduces your return.
So in a bull market, I'll underperform. Yeah.
You want to take more questions?
Yeah, we'll just go towards that. Because this will inherently ask for many questions people will have, but we'll just go through the flow initially. So we were talking about how do we select. We try to build a portfolio of between 18 to 22 stocks. So on an average, a 20 stock portfolio, and we do not take leverage. So that's the other rule. If we have margin of 1 crore, our exposure will only be 1 crore. We are not like, because it's derivatives, we can take bigger leverages. We can go to 2x, maybe 3x also. But the idea is not to take leverage. We shun leverage in that aspect. The other checkpoint we have built is that 20%, not more than 20% weightage should be there to an individual sector. The biggest problem we have here is financials tend to be more than 20%, so we have to be constantly make sure that it doesn't cross. So in the case of financials, at times, like currently it's 25%, but this is a checkpoint that we try to keep in mind. And the allocation on an individual stock is between 4 to 8%. We try not to have in a single stock more than 8%, and this is purely driven by diversification. We want to have a varied, so that in case there is a sharp jump in one stock or a sharp fall in one stock, it doesn't impact our overall portfolio too much. So we do not use technical indicators. The way we do it, it's more driven by fundamentals and technicals. Writing calls. So, so typically we sell calls which are about 5 to 10% away from where the spot prices of the underlying stocks are. One of the checkpoints is why we sell at 5% or where we sell at 10%, why the range. We try to at least sell on a strike where we get at least 0.5% premium of the strike value. So whatever the strike is, say if it's at 200, so we would sell a call that is at least 1 rupee value. So we do this so that we are able to generate a certain return on the margin that is blocked. So that filter is deployed out here. Typically we will start selling, I've written 1.25 times the calls. Say if I have 100 futures, I will sell 125 calls on top. And then gradually this amount goes on increasing as the series progresses. And a set of adjustments needs to be done on a constant, so we have we ourselves monitor, but now we also have a team who monitors these positions, and accordingly at certain points we take decisions about what has to be done. So, so we'll talk a bit more about the adjustment part. In terms of the rolling over aspect, so once we take a position in a future, we are continuing to hold that future from this series to the next series to the next series as long as we are comfortable about the valuation of the stock. So we will continue as if we own the underlying. So, and the other question is why we don't hold the stocks in cash positions. Why we do it in futures is largely because we have started doing these trades in a company because of the lower taxation that are involved in a company versus individual accounts. So there is no concept of capital gains, and so for us this becomes a very better construct on how to do our trades. Why we exclude stocks from that portfolio? Some of the reasons are, if the stock rallies too much and we no longer feel it's cheap, then we want to let go. We bought into a stock based on a certain hypothesis. This is purely the aspects that the long investing decision points. If the financials are not playing the way we thought initially, if the numbers are not, then we may decide to move up. Again, some government policy change that happens, like the export duties on steel that happens, so overnight the fortunes change for the companies. And sometimes it's because we have sold calls on top and the stock rallies so much, the calls are deep in the money, so it kind of is a forced entry out of the stock. So we'll talk about 4 scenarios as to what happens once so we have started the trade now. So we talk about the 4 scenarios that can happen, and what happens. The stock moves downwards or sideways. This is a good situation for us. We don't have to do much. We'll keep on increasing the sold calls on top. So we move from 1.25 to 1.5, 1.5 to 1.75 and up to 2.x. If the stock continues to go down, then, which is the second scenario, then what we will do is after we have moved to 2x sold calls, then we will move down the strikes also of the calls sold, so that we can generate some additional premium. So stock will do, the price of the stock will do whatever do. We are not trying to predict what it's going to do. So all we are doing is adjusting once something happens. So set the next one. So now the third scenario, which is the stock gradually starts moving up. Now in that case, say the stock price is at 100, we have sold 110 strike call. Then what will happen is, as the stock is moving up, it's reached 105. What we'll do is we will cover the 110 strike call and sell the 115 strike call. So what happens is, if the up move is gradual, we will not lose money even if in rolling up the call, because while the stock has moved closer to the sold call, and the premium should go up, but the time has also elapsed. In case 2 weeks have happened since that time, by the time we decide to roll up, we will not lose money in covering that call also. So this is the best scenario that plays out where we are making money on the call sold also and the underlying also.
Why will you not lose money? Because if the price moves up from 100 to 105,
Yeah.
the premium will also increase.
But the time, initially they were 4 weeks to expiry, now they are only 2 weeks to expiry. So there's a theta decay na, that are happening every day. As the time to expiry goes, the premium is going to shrink. So here time is our friend. That's why we are option sellers. So this is the ideal scenario that it's not always that plays out, but this is the Goldilocks scenario that we play for. Scenario 4 is this is the big problem point that happens in case the stock suddenly some announcement happens or something happens, the stock suddenly shoots up 15-20%. So over a period of time we have learned how to manage this scenarios. So depending on the scale of the move, we do that. We roll up the calls. So the calls, the premium have shot up. When there is a sharp move, the IVs also shoot up. So the premiums also exponentially move up. So we'll roll up the call. So whatever call we have sold it at, we might book a loss on those calls and sold at a much higher strike. We might decide now say at for every future we have sold 1.5 calls. So maybe we buy 0.25 more futures. So now the ratio from 1.5 it get reduced to 1.2. So we can buy futures. The other scenario is if we can sell puts on the same strike. So the advantage of doing this is because the IVs have gone up, it makes more sense to sell at higher IVs than book losses at those higher IVs. So we'll sell and we make a straddle. So if you sell both the call and the put at the same strike, it's called a straddle. So here we sell a straddle and why do we do that is because we know that on straddle only one of the legs will be at a loss, the other leg will always convert to zero. So by selling the puts at a high premium, then we now have a tool to reduce the losses on the calls. And
how do you decide the move is sharp now? Like
in a day it happens 20%. Yesterday I was 10% away. Today my call is in the money. I didn't get a chance. Overnight it happened. So some announcement comes like Axis Bank. The results came. The stock shot up 10%. Suddenly we were 8% away, and then we were in the money. So so as I said, this is the most challenging part of the trade, how to we have learned a certain way to do things. I manage in a certain way, Siddharth manages in another way. So while we keep on discussing how to manage it, but we have both found our ways of doing it. And so there are no hard and fast rules to see how to manage it or this scenario is best or that scenario. Depending on how the price behaves subsequently, you can say this was better or that was better. So, but over a period, having done this for more than 10 years now, so we have gotten comfortable. We are okay with the stock price moving up. So just to highlight a scenario in point, on Tata Power, the stock was at 170. We had sold 190 strike calls, 200 strike calls, and the stock for that series moved up right up to 260. And we kept on managing, and we ended up with a very negligible loss. We were close to break even on that. So once we have seen those kind of moves, we are okay with how much losses can happen, and this is a comfort that won't come easily to other people who are starting out, and this is something that has to be learned over a period of time. But this can be managed. That's what I'm saying. So that's a long discussion. That could be an endless discussion. So, but if you want to dig more, we can after this session.
I am confused a bit because you are selling out of the money calls Your futures are giving you much more delta. So even if you have an underlying of 1.25 future, 1.5 future,
So,
you should be making more money.
but what if,
Have your adjustments like this?
see, the point is we are benchmarking ourselves with the index also, okay? So I'm not saying I'm making losses. I'm saying this is the worst scenario that can play out. I will still, most of the times I end up making profit. I never claimed I'm making losses. So what I'm trying to say is that if this continues to happen every series, then we'll tend to underperform the index, the underlying, which is Nifty in our case, the benchmark. One of the things that we also aspire to do is to match or beat the index also. So if in case those sharp rises are happening, while we want to keep the profit of the futures, we want to minimize the loss on our options also. And we don't think in terms of deltas. Many people think like that, we don't.
What would be the need for futures then in that case? If you are not playing with delta, why would you use a
No, it's a way of doing things, na. We track premiums, you may track delta, we track premiums. It's one and the same thing.
I'm just trying to understand the logic from your side.
So what I'm trying to say is that these are the scenarios because we are net short. We are net short. So again, as I was highlighting the example of Tata Power, so the futures were long at 170, we were short 190 calls. Now if the stock price is moving to 260, then we are going to, if we don't do any adjustments, we are going to lose money on that trade. Because the 0.5 delta or 0.3 delta calls that you're talking about, they'll become 1 delta calls because they are so deep in the money.
Just one thing. So initially when you were basically laying out the ground rules, right? Basically how do you decide the unbalanced forward call? You mentioned a point which said basically reasonable valuation.
Yeah.
Yeah, basically picking the 20 stock with a reasonable valuation. Considering that you are net short, ultimately, what does that reasonable valuation actually mean?
Again, our perception, I've been an equity long investor for the last 2 decades. So I always have a view on a stock, ये सस्ता है, ये महंगा है, ये ठीक है.
So just want to understand that basically you are net short, right? So the reasonable valuation would be, for example, if it's overvalued or undervalued.
No. See, I will not be net short on all the underlying stocks, whether the stock is overpriced, underpriced, or whatever. That is part of the strategy. See, why I want a reasonably priced stock is because my real fear is the stock corrects dramatically. So I don't want to have stocks which have the potential to correct 50-60% from where they are.
Can you give an example of what did you do जब ऐसा हुआ कभी?
Well, we'll come to specific examples later on because there's so many anecdotes around that. So.
If you're focusing on 20 stock whose price is cheap, then the potential to increase is higher in those stock, and you're selling the call. So
Yeah.
chances of losing money is more when you are betting on the stocks which are
So,
cheap.
whether the stock is cheap or expensive, there is always a chance I'm going to lose money in case there is a sharp move. If a stock is cheap, doesn't mean that the probability of a sharp move in the immediate 1 month is very high compared to a stock which is expensive. See, I'm only taking the risk for the next 1 month. That's where my risk is. I'm not taking the risk for the next year or 2 years. So if the stock moves up and in the next series, I'm not going to sell the same strikes. If the stock moves up, my strikes will again move 10% away.
So basically you are selling short dated calls and then basically they are all short dated, right?
They're short dated, but we buy long dated also to hedge our portfolios at times. So we'll come to that. So, okay, so I'll come to specific examples since some of you refer to the examples. So this is scenario 2 when the share price moved, fell down. So we have sold 1.25x Tata Motors April 500. So April 2022 500 calls. So when the stock price was at around 460. And then the stock suddenly fell right up to 390. So we first we moved it to 2x, and then gradually as the stock prices were there, then we finally rolled up our sold calls from 500 to 450. So whatever is happening on the underlying, we can't control much about that. But by doing all these actions, first of all it's 2x, and then we are rolling it down by. So what we aim to do is in case there's a sharp fall, so we aim to generate about 2 to 3% by just selling the options on top. So if the fall in the stock was say 10%, by earning that 2-3% in that particular month, we are reducing by our drawdown by that much amount. And once you keep on doing it through the year, this keeps on reducing your cost of buying that future. So this is one scenario. The next one. No, I always have a view on the stock. So अगर टाटा मोटर्स 450 से टूट के 400 आ रहा है, तो मेरे लिए रीजनेबली प्राइस्ड शेयर और सस्ता हो गया. मैंने उसे बेचना तो है नहीं. I'll continue to hold it. Buy more is a different philosophy. I won't buy more because I don't want to move more than 1x of my gross exposure. So this is a scenario where the stock price gradually moves up. So we sold the stock price is at 1330 or so. We sold the 1460 calls on top. This is about broadly 8-9% away, and the stock keeps moving up as the series passes. And at a point when it reached 1400, then we decided that out of the 1460 calls, half of them we further rolled it up to 1600. The stock further kept going up. And then finally we rolled the remaining amount to 1600, and while this was done at break even, there was a slight loss in that one, but by the time the series ended, we got all the gain of the future and we didn't lose too much on the sold calls on top.
How was this at a break even? Because it only took in 20 days theta decay की वजह से.
आप यहाँ से ये भी तो देख लो ना, theta decay भी तो है. And this is the scenario 4 where a hell lot of adjustments need to be done. So this is Bharat Electronics. The stock was, it's now split. There's a one stock has converted into 3, so don't compare it with the current prices, but earlier. So the stock was close to 225 or so when we sold the calls. We sold the 260 calls. Why we were able to sell even further away from the 10% is because the premiums were high, and we could get even at those premiums we could get to our 1%. So we sold out. And then see, sometimes the premium of the options also tell you that some move is expected. So if the premiums are high, we'd rather choose to stay away rather than come close, because we don't know what. Because in India, insider news is always there, so some announcement could potentially come in. So you would rather stay safe and stay away. But the price moved up sharply. So the first level of adjustment we had to do out here. So we basically rolled up the 260 calls to 280 calls. The stock further went up. Then we sold. Then because it happened overnight that there was almost a 15 rupees move, then the IV shot up, and it made more sense for us to sell 0.5x 260 puts. And see, when we sell puts, we always do it as a put spread. We always buy puts below, because we always are conscious about our gross exposures. So we will not sell a naked put. If we sell a put, we will buy a put to protect our downside. So we also bought 0.25x futures, so that the ratio of the sold calls, because our calls sold were even after rolling that, they were 2x. So we had rolled up 0.75x, we still had 1.25x exposure. Just let me explain the adjustments after that. So this is the adjustment I'm done, and then it still continued to go up. And then the final set of adjustments is, So then we bought a call spread, a debit call spread. That is largely so in case it further breaches 280, and we had sold calls at 280, so that in order to protect that, we bought a call spread. So and then we kind of let it go at that. So finally, why we do adjustments is because we want to capture the entire upside of the futures, and we don't want to lose too much money. What we benchmark ourselves against is what we lost on the calls and what we could recover out of selling the extra puts or the other adjustments, or the additional futures we bought, how much of upside they got. So that is broadly the logic. It doesn't always work, but this is the broad construct that we did. So this is one example. There are many out there that keep on happening. So, okay. So now the concept is hedging. So you remember I made this thing that in option selling, I don't want to lose money. So in an option portfolio for the year, we don't want to lose money. Now, all that is good on the upside. If the stock market continues to go up or sideways, I'm sure I'm going to make money. What if the stock market suddenly falls, like what happened in March 2020? So in that particular case, all the returns that you have generated for the past 10, 12, 11 months, all of that was gone. I ended the year negative, slightly negative, almost 2% down. And that's the time we started thinking about is because since October 2008, we hadn't seen any correction that was more than 10-12% in a series. And now there was a month that in March itself, there was a 35% correction in a single month because of that event. So then we thought about how to handle that, and that's where we thought about this concept of dynamic hedging. So the broadly strategy is that we want to do a hedging on our portfolio in case we feel the market can go down sharply. So here we decided that one way to handle that is the only long dated option structures in India are currently on Nifty. So we decided that the longest dated options are 1 year into the future. Normally the December strike options are long dated. They might be 15. Like currently December 2023 strike put options are also trading for Nifty. For no other underlying they trade, but for Nifty they do. So one way is decide that December strike contracts is what we will play in, and what we have been doing is that we have used this technical concept of in case the index is breaching its 100-day moving average, that's the time we want to buy a protection. Why don't we continuously buy the protection is simply because the cost of buying the protection takes away the return. So you don't want to be continuously buying the protection, otherwise your upsides are it will take away from your upside. So because that is the only hedge we can buy, so that put a constraint in our portfolio construct. So our portfolio needs to be correlated to Nifty. The other benchmark we have is we only want to spend 10% of our returns for the year in buying these hedges. And when we say we are buying these hedges, we don't aim to make money on these. This is the money that we are spending to protect our downside. So we are buying largely to take care of those big corrections, not the small corrections. And our belief is that short dated options are expensive to buy and long dated are cheaper to buy. So we always will, rather than buying the monthlies or the weeklies, we'll always try to go for the longest dated option. So yeah. Okay, in terms of the performance, we put the underlying money in liquid funds, so about 3 to 5% can be generated. Now, maybe returns may be higher than 5% also, but the last 3 years.
On the long-dated options.
Yeah.
Is that market liquid now?
So it's not so liquid, but once you decide to buy them over a period of a week or at the scale we are working on, in a week we are able to do that. They are not very liquid, so we put in the limit orders and during the day they get filled out. So anyways, but those are scenarios we try to hedge. We are not taking those underlying. So our basically the benchmark is we want to exceed the 18% threshold. Historically, we have done better than that. So even our post-tax returns are higher than 18%. But our assumption is that over a period of time, the returns will go down as market becomes more and more efficient. So, but 18% threshold is something we still aspire to breach. And that time will tell. Historically, I can tell you about 14 years of data that I have traded it. I've exceeded these returns. When we did not do hedges, so 14 and 20 we lost money, but besides that we never lost money. Nifty returns we have beaten in all the years except for 2021. 21 we underperformed because the rally was so sharp. So we are never short of money to adjust because we don't take leverage. We have enough margin to adjust, do all the kind of adjustment that we want to do. So this is a checkpoint that we wanted to have that because leverage is something that I'm ever since 2008 is something that I'm mortally afraid of. I don't want to take leverage. So our broad aspirations as of this point of time is to beat Nifty returns by 8 to 10% on an annualized basis. Ensure we do not have a negative year. 2021, FY21 was a negative year, but going forward we aspire. So it was only marginally a negative year. We were down 2%, but going forward we want to ensure that even that doesn't happen. And the overall return is 18% is the benchmark. So hopefully post tax, but abhi pre tax ke term mein baat karen. That's a benchmark, but if post tax ho sake, nothing like it. So in terms of our learnings and experience, diversify करना चाहिए. पहले मैं 10 stocks में करता था. I've learned to do it in larger because sometimes exceptionally large moves happen. तो अगर उनकी weightage कम हो तो it makes a smaller impact. So the sweet spot is you find a stock जहाँ पे valuations भी आपको अच्छी लग रही हैं और जिनमें historically volatility रही है उसके कारण options के premium. So one of the stocks, one of my favorite ones जहाँ options के premium अच्छे रहते हैं is GMR. So I've been trading GMR for the last 8 years. उसमें premiums भी अच्छे रहते हैं और fundamentally मुझे कभी ऐसा नहीं लगा कि वो zero हो जाएगा share. मतलब people may have had doubts, but I track the company closely and how they deleverage. So ideally those scenarios is, but because we want now hedging to also play, we need to ensure that 70% of our option portfolio is out of Nifty stocks. So it's only in the remaining 30% we can experiment with those kind of stocks. So many people who trade options don't give liquid funds or FDs as to generate margin money. That is wrong because that itself generates a delta. So as soon as we start trading our options, 5% returns तो सिर्फ हमारे को liquid fund से मिलेंगे. उसके ऊपर हमें ये बनाना है. So if anybody is giving cash, it's a wrong approach to follow. So over the last 5 years, in my case, option portfolio has done better than the investing portfolio. In Siddharth's case, his investment portfolio has still done better than the options. But in my case, options has done better. Drawdowns are much lower than the long portfolio. And the return profile, any given month on a I wouldn't say month, but on a quarterly basis, our return profiles are very different. So the correlation is very low between the two ways of doing things. So I started in 2009. It's been a learning since then. So and as the valuations moved up during the 2001 rally, I am currently 50% of my portfolio is in option trading. So option trading is not just covered call, there are other aspects also. Sid will delve into that. But this is the largest portfolio within option trading. So the range I said 10 to 90%, and that is driven by the studies that we have done, and at the extreme points we would like to pivot between the two. But we'll be whether we'll be able to do in those ranges, but that's broadly the range at least we have in mind at this point of time. So coming to the risks, so as our friend pointed out, so sometimes the premiums are like currently the premiums on the calls are very low, whereas the underlying moves are still high. So realized volatility is what the actual moves of the stocks, and the implied is what the option premiums are telling you can happen. So sometimes it happens that the realized volatility is much higher than the implied volatility. If that continues to happen, then you kind of taking risks which are much more than are justified by the premiums you are gaining. So there are scenarios that can play out like this. A sharp move can increase the volatility sharply, the implied volatility, and because of that the premiums shoot up, and you might have sold a call at 1 rupee, and by the time it comes at the strike, the premiums could be, or I would say that you might have sold the premium at 20 IV, and once the moves happen it could be at 100 IV. So the premiums by themselves have gone up 5x simply because of the sharp underlying move. We have also had cases where suddenly the liquidity dries up, especially when new stocks are introduced into the F&O. The first couple of months there's liquidity, and then the liquidity dries up. So you don't find counterparties to the trades you have to do. So it becomes difficult after a point. And this is the underlying theme. As the size of the portfolio increases, the returns do diminish. So it's a different story. At a particular strike, if you want to sell 10 calls versus selling 500 calls on the same strike, you won't get the same premiums. So these are some of the market risks. Operational risk is large unhedged open positions. Now we trade at a certain scale. Sometimes in the last, and we have multiple accounts to manage. Sometimes what happens is the market is closing in one account, some of the options are left unhedged. So you have to wait for the overnight risk is there for you to kind of hedge the next days, but you get exposed to those overnight risks. Sometimes SEBI is one of the most proactive regulator, and because of that, especially when there's volatilities in the market, the margins that are blocked on the options shoots up exponentially, and then suddenly at times you run out of options, then you have to cut down on your positions even at a loss. We try to protect ourselves in that way that we always have sufficient margin to handle these situations, but once in a while, at least there are two times where I had to cut my position at a loss simply because I ran short of margin. The other thing that has recently happened is that earlier stock options did not result in actual physical deliveries. Over the last 2 years, what has happened is any option that is lying in the money will actually result in a delivery being taken or given by the buyer or the seller. So sometimes you don't want to actually do the transactions of buying and selling the actual. So especially if you have to give delivery and you don't have the underlying shares, then you will face a market penalty over and above the transaction cost. So we try to manage that, but because there are so many accounts, so many shares, once in a while those accidents happen. But they're marginal. They won't make a material impact, but that does happen. And the final is the outage. What if you're not able to, you have positions and a broker outage happens, exchange outage happened where people could not square off a position because NSE trades didn't happen. So those are the issues related to the market. So broadly in terms of the checkpoints for beginners, anybody who after all that I've said, the pros and cons, wants to kind of delve into that particular aspect. First of all, give margins in security which is earning some money. So fixed deposit, liquid funds, mutual funds, they could be debt mutual funds. Then SGBs are sovereign gold bonds. So sovereign gold bonds give you exposure to the underlying gold, plus they also generate a 2% return a year, 2.5% return a year, over and above that. So they are great. Then you can give your shares as margin. So cash is always an opportunity. It's always better to convert a cash into liquid fund or any other fund, mutual fund, and then give it as margin. There's a recent guideline until now. Shares could be used to get 100% of your margin, but now SEBI requirement says that at least 50% of the margin has to be cash or cash equivalent. So liquid funds or FDs are cash equivalents, SGBs are cash equivalents, but shares are not. So the maximum margin you can get is only 50%. The remaining 50% has to be gotten out of cash equivalents. So diversification is something that you need to do. It's important. Also, so whatever improbable scenarios that you can think of, once in a while they keep on happening. So if you have the mental picture of what if scenarios, अगर ऐसा होगा तो मैं क्या करूँगा, अगर ऐसा होगा तो क्या करेंगे, if you can build those, it's very easy to manage when those happen. If you're not thought through, you're bound to do mistakes. Brokerage costs do become, if you are trading intermittently, brokerage costs are not material, but at the scale and volumes we do, brokerage costs are an important aspect. So do focus on that. And what we've realized is, given the kind of trades we do, brokerage per lot is better than brokerage per order. So Zerodha not necessarily will be the cheapest one. So currently we are paying ₹1 per lot as brokerage. There are offers out there in the market which are even lower than this. So on a per order versus per lot basis is an open debate. Just because it's on a per order basis doesn't mean it's the cheapest. So Nifty, like coming to Nifty, like in bank, NSE has put a cap in terms of how many orders, maximum lots can go in a per order basis. Like for Bank Nifty, it's one lot is 25 quantity. The maximum order that can go is 1200 quantity. So 1200 means 48 lots. So maximum 48 lots can go in one order. So if it's ₹1 per lot, I will be charged 48 rupees, whereas Zerodha will charge you 20. But I'm not always going to trade in multiples of 1200. I might end up trading in 100 also, or 25 also, or 50 also. So while you're making all those adjustments, if I'm trading just giving one order of one lot, there Zerodha again will charge you 20, whereas my broker will charge me ₹1. So, pardon?
Who is your broker?
Sher Khan. Sher Khan is not the only one, others are also giving, it's not like.
So what we discussed till now, covered call, is a sort of a directional strategy, because you are biased towards long, because you are holding a portfolio of securities which is biased towards long, and it is much easier to make money when the market is rising. When it is falling, you need to defend and control your drawdowns, and hopefully with the hedges you cap down your losses. But it is clearly a directional strategy where things are easier to do when the market is rising. Gradually is the easiest. But now we also mentioned that for doing covered calls, for the total pool of capital that we have dedicated to options, we only need to use a small part of it to run our gross exposure at 1x, which means there is a lot of ideal margin available to us to see if we can generate some income out of that strategies. But now, since we don't want to take gross exposure greater than 1, so what we want to look at is non-directional strategy. That is, we are not taking any view in the market. Market can go up or down or stay there. We would probabilistic want to make money in either of the scenarios. We can lose money if the market goes up, or we may also lose money if the market goes down. But our expectation is that over a large number of trades, we would have a positive outcome, irrespective of market does whatever. And these trades we largely do in index options, because index options are the most liquid instrument out there in India today. And index options also have a peculiarity that they have weekly contracts also which expire. And the weekly, so it's just like, if you are running a casino, and when we say ki, we are doing enough transactions and we expect a positive over large number of trades, we expect a positive payoff, right? So what we need to have to do is to increase the number of transactions, because in any particular transaction you can still make or lose money, but over a large number of transactions you would have a positive payoff. So you need to increase the number of frequency of trades, and weekly helps you do that. So index options is why we choose. Now I'm going to quickly talk about some of the strategies that we have done, and it has been a learning curve. So these index options in Nifty started trading only in 2019. So in the last 3-4 years, we have spent a lot of time looking at this, and as our experience grew, we have modified and tweaked a lot of these strategies over time. And these are just some of the strategies. And the nomenclature is also, these may not be standard. This is something that we internally call these strategies when we refer to this. What is an iron fly? Iron fly is a standard term which just means that, you are selling. Does everyone understand the straddle here? So basically you are selling call and put at the same strike, but that exposes you to big losses on if the market moves in either direction, but you want to cap it off. So you sell an iron call and put at the straddle, but you buy protections on both sides, which is further out. So for instance, for November this November expiry, if say 17,800 was the spot, we sold both 17,800 call and put, and we bought 16,900 put and 18,700 call. So this caps our risk. So we are not going to lose beyond a certain point. And how did we decide on this 16,900 or 18,700? Because straddle is easy. At the money you sold it, and when we sold it, say suppose we got roughly 600 rupees premium. 600 rupees was the premium that we got combining the two legs, and we want to buy protection which is 1.5x away from that. So that is 900 points away from that on both sides. So roughly 6,900 puts and 18,700 calls. That is how we capped it. So we have 600 that we got upfront, and we paid roughly probably 100 for the protection. So we have 500 rupees net premium with us. If on the expiry, if the Nifty is between 500 points of 17,800, we make money. But if it crosses that, we may have a loss, but the loss is capped. So this is if we just do the trade and do nothing. This is the risk reward. So you can you can lose 500 bucks or you can make 500 bucks is roughly equal. But as an active trader or investor, once market moves in either direction, we will try to adjust, which will improve the risk reward. So now if you think of it, you started with a trade which has 1:1 payoff, but with your adjustment, now you have tweaked the payoffs odds better. So, and if you do keep on doing a large number of such trades, on an average, you will end up making money. And how do we do these trades? How do we adjust this? To give an example, say suppose the Nifty, after we started the trade, market falls. And what we will do is we will wait till the market drops 600 points, which is was the initial premium that we got, right? So net we got 500 points. So let it fall 500 points. When it comes to 17,300, we will sell another straddle, and we buy the protection at the same point, 16,900. I think this is wrong here. We will buy 16,900 put here at the same point. Huh? Yes, these are all November. So these are November 22. You sell those puts and buy where the original protection bought at 16,900. You buy at the same point. So you will see now that on the downside,
Protection of the call side not to what now?
for the second leg we are not buying it. I'll explain you the reason also why. So first of all, now my downside is I'm being tested on the downside. The market is going down. So for this new trade, once I do this adjustment, now you see there is no loss on the downside. But I am still exposed to a larger loss on the upside than what initially was, because now it is unlimited loss theoretically, because it is open current, right? And the reason for doing this is, so when it starts moving back towards 17,800, so what you will do is, as soon as it reaches 17,600 or 700, your original trade 17,800 would have a large decay in premium, because almost 2-3 weeks would have passed. Something that you sold for 600 premium would probably be worth maybe 250 now. So you have a large decay in that. And the new straddle that you sold at 17,300, maybe you are losing 50 or 100 rupees on that. If you close the entire thing, you will still make more than 1 or 2% on the margin that was blocked. So we had it as an adjustment strategy from the start. We had in our mind, if the market starts recovering, the new adjustment trade, we will book at a small loss, because now the trade is coming in our favor. And we want, for ideal case for us is the market comes back to 17,800 and it expires there. Then that will be our biggest payoff. And you again diversify across Nifty and Bank Nifty, across weekly, across monthly. So you have several types of trades which are going on at the same time parallelly. And one of them, and you can also position your trades in a way that some trades benefit from market going up and some trades benefit from market going down after your adjustments. So even though the trades are non-directional.
If there is a big upward move, would you do a same straddle on the call side?
Correct. Correct. So this is similarly something in Bank Nifty. We called it bat trade because the payoff profile is shaped like a bat ears. So what is initially you are doing is, you buy a call option, you sell 4x call options which are further out, and you then buy its protection 3x. So you cap the loss. And this in a way gives net, and similarly you do on the put side, you buy a call, sell 4x puts, and then buy 3x puts. So in the interim, if the market expires, you expect a positive expectations. So these are some of the data from the website we shows. To do this one set of trades, we need roughly 2 lakh worth of margin. The peak profit possible is 20,000, and the peak loss possible is 42,000, which is 10% profit and 21% loss. This is as the initial setup. And of course, as the trade moves, you will try to adjust it. Like the original trade, there are various adjustments possible here, and that would depend on the time and the size of the move. You can create another layer of similar trade and extend the break even, right? So this risk reward becomes very favorable over time. This is a bad trade. Then in a low vol environment, what we can do is, this is called a rolling straddle. We sell straddles 45 days to expiry, and instead of selling one, you sell 3 consecutive, like 17,700, 800 and 900. You sell, say suppose you are in mid of November, you sell the December expiry. And for them, the protection you buy in the weekly. Why we buy in the weekly? Because as the markets keeps moving, you keep on rolling your straddles with the market. To explain it, say you sold 17,600, 700 and 800. As soon as the market crosses 17,800, you cover the 600 and sell the 900. So you are always keeping your straddles with the market. And we are doing it only in times of low volatility. When the market seems stuck and the vols are low, then the moves are also not that big. And your black swan events are handled by buying your protection in weekly. And this also we did it for quite some time, and we had a very good experience and payoffs here.
But if you're buying protection in weekly contract, then time decay is higher in those contracts.
But we are buying far out, na? Which are very.
Premium is not very high.
So you are buying something which is worth 2 rupees or 3 rupees. So just for black swan protection. So algorithmic trading. So this is, I'm sure a lot of you are aware of, this is catching up in India. There are today globally 70% of the trading volume happens through algorithms. In India also today, of the overall turnover in the exchange, more than 50% happens through algo trading now. Option trading using algorithms used to be something which was, done by only proprietary firms or big brokerage houses for their own money or clients' money. It has more, in the recent 2-3 years, it has become more popular among retail investors, and one of the reason is now availability of both backtesting and execution platforms who give access to people who may not have the capability themselves to backtest ideas and to create execution infrastructure. They are now very easily available at low cost, so which is prompting more and more retail people to also test and automate their trading strategies. And these strategies could have different styles, and a whole gamut of strategies are possible. Some things with very low drawdown and reasonable return, which is say 18% sort of an annualized return, and almost negligible drawdown, which is what a lot of proprietary trading firms would do, sitting with all the infrastructure. And then there could be strategies where people are willing to take 10-20% drawdown on the capital, but the expectation is to make 50-60% sort of a return in a year, and that is also something which has happened, people have achieved. We speak to a lot of option traders in the last 3-4 years, it is very common. I think a lot of people have a negative connotation about option trading, that this is something very risky. That as Warren Buffett said, options are weapon for mass destruction, and your portfolio can suddenly blow up overnight, and you should not do it and stay away from it. To dispel this myth, I'll try to show you some examples. So these are there are 2 listed companies in India whose main source of profits are algorithmic option trading. So Share India Securities is listed today. Share India accounts for more than 8% of option trading volume in India. They are a listed company on exchange, and if you look at their capital, if you look at their total capital, so last year their capital was 414 crore. On a 414 crore, they had an operating profit of 300 crores in algo trading, because they have levered it up a little bit by borrowing money. So for a trading firm, you will lever it only when you are very confident of drawdowns, that you would not have your drawdowns is in control. So you can go to websites and look at the quarterly returns. They are very predictable, very stable. And you can see year on year it has increased, consistently. 6 crore, 8 crore, 15 crore, 25 crore, 40 crore, 80 crore, 200 crore profit. This is a consistent increase over the year of the scale of operations. Trading, broking, they do. They also do broking business, but broking obviously is not at the same league. The second firm is called Daulat Algotech. So they don't even do a lot of broking. This is largely execution, trading, and similar scenario. So their profits, I think 47 crore, 77 crore, 85, 185, 214 on a similar sort of capital, 500 crore. If you look at for both the firms, their average ROE, return on equity, is more than 40%. The last 5-year average, it's not a 1-year average or 2-year, last 5-year average return on equity is 40%. And because we have spent some time looking at these things, we understand how is this possible, and this is not something unrealistic or not something which cannot be scaled. These are the examples. People have actually scaled it and are doing it, and they will continue to do it, scale it even further from here. So these are some of the successful examples which clearly show that option trading may not be as dangerous as people think. I think a lot of people have already decided that it is dangerous without delving or spending too much time into it. Just like that, I have decided that cryptocurrency is hogwash. I should not look into it without spending any time in it. Maybe it is not as risky as it may sound. So be open-minded about it, think about it, see the data is front of you. There are people who are consistently doing it at scale, doing it profitably. Maybe there is something to it which helps you. So our options in index, I'll very quickly summarize this. So we have traded it for last 3 years. Our aim to generate was 24% with negligible drawdowns. Strategies have been evolving over time as we continue to tweak the return profiles. We have for the last 3 years very comfortably exceeded our 24% threshold. Returns are uncorrelated with the equity markets because market have been all over the place and every month we have made money. Have not had a negative month so far in the last 3 years. 1 month was close to break even. Profitability of the trades here depends on adjustments. Once you initiate the trade, because the risk reward initially is almost 1:1, and if you do nothing, maybe it will not be as profitable. It depends on the adjustments, and one gets better at it with time and experience. So this is a problem also because you cannot really outsource it. I mean, what the adjustment I can do, my dealer cannot do. He needs to spend time to build that mental, facilities. Challenge is also scaling up individual strategies beyond the size, because as we looked in bad trade on a 2 lakh margin, you could have a 40,000 worst case loss. Obviously, that is something not acceptable, even if a large number of you are doing large number of trades. You cannot scale it beyond a particular point. You need to have a large number of strategies or a large number of individuals. Returns are influenced by the volatility. Higher volatility means typically higher returns. Weekly strategies are very lucrative but are also very time intensive. So they take up of a large amount of our time, which is why we are trying to now slowly withdraw from it and move towards algorithmic trading to reduce our time commitments. Algorithmic trading is something where we have spent a lot of time in the last year. This is still a work in progress. We have had some initial success, but we'll see how the future unfolds here. So yeah. Sorry guys, I've kept you guys waiting for lunch. Maybe Q&A we can have along the lunch. Okay. Yeah, sure. Go ahead.
So you told special situation. That was some math and some skill. And you told this indexing, that is also some math and some skill. So average guy who was done graduate from Devani, he can do special situation. No offense if somebody has done from Devani. And how much do you put a skill level to this, or it is basis or more of experience before you refine your strategy? So I want to understand that ratio, any qualitative, okay, that is special situation is maths also and some skill also, and this is also math and some skill. Which bracket would you put more, how much, any color on that?
I think option trading requires more skill because I think especially when you are doing this, I think covered call versus index trading is also very different. Covered calls is relatively easier versus this to manage, because here the actions is very fast paced and in a small window you need to act, and one gets better over time. One has to spend time to learn this. I think special situations are relatively not as complex in terms of the kind of actions that you need to do at certain price points. Here one needs to constantly learn. Even today, maybe the kind of adjustments that we are doing, they may not be the best adjustments, right? And there could be a way to do these things better. And this is something that we have realized over time. It is a continuous learning process. The kind of things that we are doing today is hopefully better than what we were doing, 2 years back, and maybe 2 years from now, what would we doing would be even be better than what we are doing today. So one has to spend time at it. But I think important thing is when I started, I think I started trading options in 2016-17 with covered calls initially, and this is 4 years back, and it is learnable. It is not very complex. Like anything, if you dedicate time, it can be done. But this is not something which I would say can be done part-time. If you think that, I would do one trade a week once in a while, then this will not work. I think because this requires, continuous spending time to learn and see. You need to see enough data to form what works. Covered call can be done more passively. You don't need as active, but still when, if you have done unbalanced covered call and you have aggressively sold calls and you have naked positions, then you cannot be very passive about it, because that risk has to be actively managed. Otherwise, the losses could be.
It was not about active or passive, the intelligence level.
I think.
I don't think so.
I don't.
It's more difficult to learn it. See, investing versus options, it will take more time to learn, but it is learning.
Learnable. It's not complex.
So, and to your point, covered calls, while it requires less intensity, but the learnings are around how to manage. And those experiences, first those instances have to come to you to learn to know, so that in one particular trade you lose money and you realize the next time what is a better way to handle it.
And
Get that out.
to explain a little bit further, because you talked about engineers and the maths. So some of our best option traders are CAs. So they had accounting background of few years of, they did audit kind of work. And today they are running, very good algorithmic trading books, managing hundreds of crores. So it is learnable.
Any accounting softwares, back office accounting softwares to keep track of all these things apart from the group or utilities?
M-Profit can automate everything for you. That is, I think, a good utility at a reasonable price, which takes care of all these headaches.
Good site for special situation events?
Sorry?
Any good site for tracking special situations?
There are individual blogs, yeah, but it depends on the enthusiasm of the guy underwriting.
Corporate actions.
So, BSC notices are there, then the other place is the screener has certain, you can put in those filters. But tracking the actual date is, you will have to build your own trackers. Nobody is going to do that homework for you.
And I think over time, a lot of action has moved from online forums to WhatsApp and groups. Where if you are over time, if you are serious about it, you will get into the right group. So where people keep on sharing, like-minded people keep on sharing data. You were asking something, please?
Just connecting the final, you started with the asset allocation thing. There you also told about the shifting to allocation based on the market levels. Like when you're finding markets in the higher zone, shift more towards income strategies. But your premise for starting income strategies is reasonable valuation portfolios. Isn't that contradictory by itself?
So, there are two aspects to it. You are right in a one sense. If you have decided that you want to be in income strategy, right? But if you think the valuations are high, because you have bought hedges, you are not worried about the valuation as much anymore. Say, if I have my covered call option portfolio, which has 70% correlation with Nifty, and even if I think market is overvalued, but I have bought long-term puts as a hedge, so I know this is the maximum that I can lose. So I have protected my downside, right? Even if the valuations are at extreme, the protection takes away, buying those hedges takes away that valuation risk for me, which is, if you want, you can also do it for investing.
So buying hedges has been a game changer for us, because the same question that is in your mind has helped us handle that particular question, what if scenarios. So the what if scenario for us is March 2020. Now buying those hedges at certain price points, we can model it out, and we are pretty sure we might lose the gain till those hedges, but after those hedges, nothing more, no more damage will happen. And so our hedges typically are about 10% away from the market.
Okay, so I think
Thank you very much.